All right, so today FOMC is out there live and in charge, I think, doing a lot in terms of maybe setting the market back on fire. We'll break into all this for you guys today and do a live stream that will get a little bit of Chair Powell's response to the press corps. So you guys have probably seen this before. My name is Paul Barron. Welcome back into Tech Path. Now, let's get into a couple of points here. FOMC clearly has an agenda, and I think what we've been talking about here on the show is starting to showcase in a few of the moves that were announced in today's FOMC meeting. The summary of the Fed decision, this is coming in right now. Fed leaves rates unchanged for a third straight meeting, so that's a big deal. Fed also says growth of economy has slowed since Q3 2023. That's another big factor that I think is going to play into this, because remember, when we get into the issues around the economy and inflation, there's two things that are affected here. The first thing, of course, is going to be inflation or prices, because if there's less money injecting into it, whether it's through credit or just consumers slowing down, it's going to obviously reduce inflation. But the bigger picture is jobs. That's the lagging indicator that I think a lot of people really understand, because that is the Fed's job. They are trying to make sure that they get to what they call price stability. And that, I think, is starting to show its head for the very first time after almost 18 months of cutting. Most Fed officials now see interest rate cuts in 2024. That's a big change, because a lot of people were kind of back and forth on this as to whether or not we would see interest rates at all in 2024. And now the Fed also is looking at median projections showing 3 rate cuts in 2024. That's a big advancement. It's also why I think you're seeing a little bit of the charts right now starting to move. I look over at Bitcoin right here, starting to move up from its low right there at around 40,007, and we are already pegging right at around 42.4, coming in at 42.2 right now on a green candle. So all this is playing into what could line up as a very, very strategic first quarter. Remember two of the things that we're watching right now. Jobs. Obviously, credit is now kind of behind us. It's in the rearview mirror because we've started to see the slowing of credit. Next up will be jobs. And this is the lineup that we've been talking about for over a year. This is really what will be the key indicator that will help the Fed get to a point of slowing and potentially reversing rates. So that's the biggest factor. The first time we see a rate cut, along with a halvening, along with an ETF, you have some very perfect storm elements brewing right now that could be huge for the markets. If you go back to the alignment here, Fed sees 4.1% unemployment by the end of 2024. And people would look at that and say, well, wait a minute, that's way up. That's a bad thing. Yes and no, because remember, unemployment lags behind what happens in the price market, what I just explained there. If people are starting to actually lower prices, it means that there's less sales. Less sales means less people involved in retail. And the biggest sector of all that charges employment, both on the positive and the negative side, has been hospitality. Restaurants, bars, hotels, that's where all the growth has been. And now we're going to most likely see a reversal of this coming in Q1 for next year. Last item was number 6, Fed seeing a U.S. GDP growth of 2.6 in 2023 and 1.4 in 2024. Again, that shows a contracting market. It shows a slowing market in terms of GDP. Again, not great, but the point is that the Fed has to look at this and say, have they done enough damage? And I think that's the factor that maybe the Fed has engineered either a no landing or possibly a soft landing here. Going to be interesting to watch for sure, because if you look at the S&P, let me kind of jump over to that real quick for you guys. By the way, we will be taking, S&P now getting ready to crack 4670, could be going into 4700 here, possibly on the day. That would be a big jump. But point being is you can kind of see the movement we've had over the past couple of weeks, really since the 27th of October, has been pretty much straight up. What is the growth on that for S&P? Yeah, you're looking at almost 13%. I mean, this is crazy. This is a supercharged and super hot market right now. A lot of people still worried, and this is something that everybody needs to, keep in your back pocket, is that many people are still considering, is there a correction lining up? All these things are good that we're hearing so far, in the essence, it's bad for the market, the economy, and jobs, but it's good for a market correction and reversal on this. But when you have the S&P kind of pricing all of this in, maybe not necessarily as good as everybody thinks. Make sure, by the way, I want you guys to take a second, smash the like button if you like these kind of breakdowns. We will run through some tokens toward the end of the hour, so make sure and stick around for that towards the end of the show. We'll get into some charts and drop some comments and some questions. I'll take some questions from you guys today and hopefully flow into a little bit of that at the end. Let's go into a couple other things. Let's go into Wall Street. Yeah, here we go. Wall Street's fear gauge now lowest since November 2019. This was ahead of the PBI, which is better than consensus, so not bad. You look at a couple of points that were in this chart on the VIX has fallen to the lowest level since November 2019. Another good one. Fear has evaporated as most market mechanics have now started to take over. Just what I just showed you in the S&P. If you look at where that relates to what is happening within the crypto markets and risk assets in general, again, maybe you guys just missed another dip. Hopefully that was not the case, but don't get in those scenarios where you get caught FOMOing in. There's going to be these kind of corrections, these little market adjustments like this throughout this next bull run. There will be opportunity. One other thing, when fear completely evaporates as some event comes along that causes the stock market to drop, that's what we're watching for. So be aware those kind of things can move to the next level for sure. This came in from Green Whale. Crypto could be measured at fair market value under the new FASB rules. This is a big deal if you guys are in business today and you have to understand you're abiding by certain accounting rules, whether you're an LLC or C Corp or any kind of business. This changes things up a little bit. This is a report from Bloomberg saying that new financial accounting, we've reported on this. This has been around for a couple of months now, but now it's starting to showcase the actual model in which this can be done. So the rules have stated that crypto now will be measured at fair market value. And moreover, the report notes also that the accounting rules are set to go in effect in 25. So we're going to see this pretty quickly. And they're also poised to have a massive implication on crypto holdings when they do. And what that simply means is that MicroStrategy, Tesla, other companies now, especially as we get into Wall Street coming into this game, we're going to see a lot more businesses starting to hold crypto in their treasury. And the fact that they can treat this as a financial accounting standard is going to be huge. So highs and lows of the markets can go with that. So if they're losing money, they can adjust that down and it becomes a tax potential loophole for them as well as an advantage in these kind of scenarios. So all of this also very good. Remember, there was other news this week where Google is now going to allow crypto advertising, most likely for the ETFs, which begins in January. Why the rush? Well, they see money on the table and most likely what could be a absolute marketing bonanza around the ETFs going within that. Talking about that, BlackRock, a couple updates right here. This was a memo filed on the 28th of November. BlackRock disclosed a new in-kind redemption. This is kind of the prepay model that will allow banks to act as authorized participants for the ETF, another big deal. And also the new model proposed in the meeting with the SEC, which was attended by 6 executives from BlackRock, 3 executives from the SEC. Sum up, right? I just feel like this is getting to the point now. Wall Street definitely is at the table for sure. Taking a look at the market too, let's see how it's responding in the short period of time. Bitcoin's still moving. All right, so kind of curious, what do you guys think? Do you feel that this is the position that we've been looking for toward the end of the year, kind of that Santa rally potential going into the first few days of January? And remember, we just had Mark Yusko on, and he actually brought something up, January 8th. Remember, that is within that window of the 5th or the 10th that we could get that. And Monday is January 8th. That's, of course, Elvis's birthday, but, you know, I like it. The new king will be possibly born on that day. So it'll be an interesting one for sure. All right, a couple other things that are happening that, again, very good and I think bullish for the market globally. And that, of course, is Coinbase announcing their next phase of their international expansion and the launch of the non-US spot markets, also eligible customers within that, you know, in terms of a global user base. This is going to only continue to grow Coinbase as a company, which only makes it stronger for the United States. Remember, this is a U.S. company, IPO and or public traded company, and still, I would say, the most trusted exchange right now in crypto, quite likely the one that will dismantle the SEC when it comes to securities and whether or not tokens are securities, as we start to see the motion to deny coming up soon as well. Excited to see Coinbase Asset Management launch Project Diamond. This is another thing that's moving along. Platform allows for debt product issuance, fully digital native on-chain and under what they call ADGM in principle movement or approval. Tech stock is coming together, and it's built on public permissionless network. So this is what we've been talking about, of the retooling of the financial system. And, you know, again, back to, by the way, if you didn't watch the video yesterday with Mark Yusko, go back and watch that one, because, you know, Mark and I got into this. This is in a good way, in the sense that finally we're dealing with issues that, and we'll go to the live stream here in a second as soon as Chair Powell comes on, usually right around 2:30. So stick around for that. You'll get a chance to listen in. And then I'll kind of, you know, step back a little bit, because I want to hear what Chair Powell says. This is a very critical statement to the press, because if we get a dovish move here from Chair Powell, along with the report that has come out of the meeting, aligning with both jobs, credit, and I want you to listen for very big issues here, is how quickly jobs can correct. And when I say correct, meaning we're going to continue to see acceleration in the job market. So that's what I'm watching for, because that will give me a little bit of indicator as to whether or not we'll see a Q1 rate cut. Now, if we get a Q1 rate cut, now we've got fuel, and we're talking about rocket level fuel. So that will be the one I'm watching for the most. We'll cut to that in a second. But I was talking about Mark Yusko's interview with me yesterday, and we got into this whole issue around the financial system. You know, when you look at these growth models that we've seen in blockchain, Web3, and all this, one thing, and I don't know if you guys know this, we have a consulting business that we do a lot of brand consulting in. And the thing that has been happening over the last 90 days has been a very quick pickup of major companies coming to us and starting to ask questions. And what I mean by questions is they want to know more about blockchain. They want to know more about Web3. They want to understand NFTs and how that can be integrated into brand loyalty and IP. This to me is very similar to when, you know, there were companies starting to ask about social media and really trying to figure out how they get involved. And this is a critical component, because when you get major business, Fortune 500, starting to move into this market, remember, one thing that they need is a surety. What they're looking for, and I think this gives it to them, is what's happening with BlackRock and a lot of Wall Street. Wall Street starting to open up here. They still see the regulatory environment being quite hostile. But one thing that was said to me just this last week by a CEO of a major retail chain, and he simply said, listen, we're not really worried about regulation. The minute that we start seeing regulation fronts come up, we realize that there's getting ready to be change. And this is something that, you know, we talk about all the time. Chair Powell is getting ready to go live here in a second, so we will be airing his address to the press corps there for the Fed meeting, for the FOMC. So stick around for that. And again, at the end, we'll try to get to a couple of tokens, give you guys some insights on that. Also, JP Morgan has tripled its internal crypto trim. This is so crazy. For Jamie Dimon to go in and do the things he's doing to kind of, here we go. Let's get into this. Let's go ahead and go live to that. All right, here we go. Stay tuned. Smash the like button, guys.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. As we approach the end of the year, it's natural to look back on the progress that has been made toward our dual mandate objectives. Inflation has eased from its highs, and this has come without a significant increase in unemployment. That's very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. As we look ahead to next year, I want to assure the American people that we're fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. Our actions have moved our policy rate well into restrictive territory, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening likely have not yet been felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks that we face, the committee is proceeding carefully. We will make decisions about the extent of any additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has slowed substantially from the outsized pace seen in the third quarter. Even so, GDP is on track to expand around 2.5% for the year as a whole, bolstered by strong consumer demand as well as improving supply conditions. After picking somewhat over the summer, activity in the housing sector has flattened out and remains well below the levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our summary of economic projections, committee participants revised up their assessments of GDP growth this year, but expect growth to cool, with the median projection falling to 1.4% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 204,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth appears to be easing, and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises somewhat from 3.8% at the end of this year to 4.1% at the end of next year. Inflation has eased over the past year, but remains above our longer-run goal of 2%. Based on the Consumer Price Index and other data, we estimate that total PCE prices rose 2.6% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 3.1%. The lower inflation readings over the past several months are welcome, but we will need to see further evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. As is evident from the SEP, we anticipate that the process of getting inflation all the way to 2% will take some time. The median projection in the SEP is 2.8% this year, falls to 2.4% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. While we believe that our policy rate is likely at or near its peak for this tightening cycle, the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. We are prepared to tighten policy further if appropriate. We're committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. While participants do not view it as likely to be appropriate to raise interest rates further, neither do they want to take the possibility off the table. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of 2024, 3.6% at the end of 2025, and 2.9% at the end of 2026, still above the median longer-term rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. In determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you, Chris Rugaber.
Just as a reminder, get some
Associated
questions
Press.
in.
I
We'll
wanted
try
to
to
ask,
answer some toward the
how
end.
should we interpret the addition of the word any before additional firming in the statement? I mean, does that mean that you're pretty much done with rate hikes and the committee has shifted away from a tightening bias and toward a more neutral stance? Thank you.
So specifically on any, we do say that in determining the extent of any additional policy firming that may be appropriate, so any additional policy firming, that sentence. So we added the word any as an acknowledgement that we believe that we are likely at or near the peak rate for this cycle. Participants didn't write down additional hikes that we believe are likely, so that's what we wrote down. But participants also didn't want to take the possibility of further hikes off the table. So that's really what we were thinking.
Mr. Chairman, the microphone, sorry. Steve Leisman, CNBC. Happy holidays, Mr. Chairman. Fed Governor Chris Waller said that if inflation continues to fall, then the Fed in the next several months could be cutting interest rates. I wonder if you could comment on whether you agree with Fed Governor Waller on that the Fed would become more restrictive if it didn't cut rates if inflation fell. Thank you, sir.
So, of course, I don't comment on any other officials, even those who work at the Fed. But I'll try to answer your question more broadly. So the way we're looking at it is really this. When we started out, right, we said the first question is how fast to move, and we moved very fast. The second question is really how high to raise the policy rate, And that's really the question that we're still on here. We're very focused on that. As I mentioned, people generally think that we're at or near that, and think it's not likely that we will hike, although they don't take that possibility off the table. So that's, when you get to that question, and that's your answer, there's a naturally it begins to be the next question, which is when it will become appropriate to begin dialing back the amount of policy restraint that's in place. So that's really the next question, and that's what people are thinking about and talking about. And I would just say this: we are seeing strong growth that appears to be moderating. We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see. We can't know, we still have a ways to go. No one is declaring victory. That would be premature. And we can't be guaranteed of this progress. So we're moving carefully in making that assessment of whether we need to do more or not. That's really the question that we're on. But of course, the other question, the question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view. And is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
Can you give some color as to the nature of that discussion today? Thank you.
Sure.
All right, so coming into view is that's a big statement by Chair Powell, meaning that they have this on the table now for rate cuts. So that's a big issue right there.
Mentioned what their rate forecast was. And there was no back and forth, no attempt to sort of reach agreement, like this is what I wrote down, this is what I think, that kind of thing. And a preliminary kind of a discussion like that, not everybody did that, but many people did. And I would say there's a general expectation that this will be a topic for us looking ahead. That's really what happened in today's meeting. I can't do the head count for you in real time, but that's generally what happened today.
Go to Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. At this point, can you confidently say that the economy has avoided a recession and isn't heading for one now? And if the answer is no, I'm curious about what you'd still be looking for.
I think you can say that there's little basis for thinking that the economy is in a recession now. I would say that. I think there's always a probability that there will be a recession in the next year, and it's a meaningful probability no matter what the economy is doing. So it's always a real possibility. The question is it? So it's a possibility here. I have always felt since the beginning that there was a possibility, because of the unusual situation, that the economy could cool off in a way that enabled inflation to come down without the kind of large job losses that have often been associated with high inflation and tightening cycles. So far, that's what we're seeing. That's what many forecasters on and off the committee are seeing. This result is not guaranteed. It is far too early to declare victory. And there are certainly risks. It's certainly possible that the economy will behave in an unexpected way. It has done that repeatedly through in the post-pandemic period. Nonetheless, where we are is we see the things that I mentioned.
I'm curious if you're looking back on the past year, you talked about navigating by the stars under cloudy skies. Can you talk about some of the ways in which the economy surprised you most this year, where you thought it would behave in one way and had to pivot to respond? Thanks.
So I think forecasters generally, if you go back a year, were very broadly forecasting a recession for this year, for 2023. And not only did that not happen, that includes Fed forecasters and really essentially all forecasters. A very high proportion of forecasters were expecting very weak growth or a recession. Not only did that not happen, we actually had a very strong year. And that was a combination of strong demand, but also real gains on the supply side. So this was the year when labor force participation picked up, where immigration picked up, where the distortions to supply and demand from the pandemic, the shortages and the bottlenecks, really began to unwind. So we had significant supply side gains with strong demand, and we got what looks like a 2.5% plus, or a little more than that, growth year at a time when potential growth this year might even have been higher than that, just because of the healing on the supply side. So that was a surprise to just about everybody. I think the inflation forecast is roughly what people wrote down a year ago, but in a very different setting. And I would say the labor market, because of the stronger growth, has also been significantly better. If you look back at the S&P from a year ago, there was a significant increase in unemployment. That didn't really happen. We're still at 3.7%. So we've seen strong growth, still a tight labor market, but one that's coming back into balance with support from the supply side, a greater supply of labor. It's that's what we see, and that I think that combination was not anticipated broadly.
Thanks, Howard Schneider with Reuters, and thanks for taking the questions. I wonder if you could give a little more color or detail on what motivates the lower rates next year. Whether it's a coincidence, for example, that the spread between PCE inflation, core inflation, and the federal funds rate stays constant over the year. Are you simply calibrating against the fall in prices, in the price level that you're expecting, in the rate of inflation that you're expecting, as opposed to supporting the economy?
Nothing quite that mechanical is happening. The S&P really is a bottoms up, built from the bottom up, right? So I think people are looking at what's happening in the economy, and I think if you look at the big difference from September in the S&P, the expectations for inflation this year, both headline and core, have come down, really significantly in 3 months. That's a big piece of this. At the same time, growth is turned out to be very strong in the third quarter, is slowing, we believe, as appropriate. And we've had several labor market reports which suggest, again, significant progress toward greater balance across a broad range of indicators. You're seeing so many of the indicators coming back to normal, not all of them. But so I think that people look at that and they write down basically each individual writes down a forecast and a rate forecast that goes with that forecast. We tabulate them and publish it. And so it isn't, you ask about real rates, I take it, that is something that we're very conscious of and aware of and monitor, and it's certainly a big part of, it's a part of how we think about things, but really it's broader financial conditions that matter, and as you well know, it's so hard to know exactly, what the real rate is or exactly how tight policy is at any given time. So you couldn't follow that like it was a rule and think that you would get the right answer all the time, but it's certainly something that we're focused on. And indeed, if you look at the projections, I think the expectation would be that the real rate is declining as we move forward.
It sounds like the discussion over that, if I could follow up, has already kind of begun. I'm wondering, just related to Steve's question, how the tactics of this play out, given the slowing of inflation and the fact that the deeper you get into 2024, the closer you get to a presidential election. Do you want to front load this, in other words?
Yeah, no, we don't think about political events. We don't think about politics. We think about what's the right thing to do for the economy. The minute we start thinking about those things, we just can't do that. We have to think, what's the right thing? We'll do the things that we think are right for the economy at the time when we think is the right time. That's what we'll always do. So I mentioned we're moving carefully. One of the things we're moving carefully about is that decision over, that assessment really over whether we've done enough, really. And you see that people are not writing down rate hikes. That's us thinking that we have done enough, but not feeling that really strongly, confidently, and not wanting to take the possibility of a rate hike off the table. Nonetheless, it's not the base case anymore, obviously, as it was 60, 90 days ago. So that's how we're approaching things. And as I mentioned, we wrote down this SEP, and it talks about people have individual assessments of when it will be appropriate to start to dial back on the tight policy we have in place. And that's a discussion we'll be having going forward, but that's another assessment that we're going to make very carefully. So as time goes forward.
It's coming in a little bit more
Nick Timrose
dovish
of the Wall
than I
Street
thought.
Journal. Chair Powell, you've argued over the last year that policy tightening started before you actually lifted off because the market anticipated your moves and tightened on your behalf. The market is now easing policy on your behalf by anticipating a funds rate by next September that's a full point below the current level, with cuts beginning around March. Is this something that you are broadly comfortable with?
So this last year has been remarkable for the sort of seesaw thing, back and forth we've had over the course of the year, of markets moving away and moving back and that kind of thing. So, and what I would just say is that we focus on what we have to do and how we need to use our tools to achieve our goals, and that's what we really focus on. And people are going to have different forecasts about the economy, and those are going to show up in market conditions, or they won't, but in any case, we have to do what we think is right. And, in the long run, it's important that financial conditions become aligned or are aligned with what we're trying to accomplish. And in the long run, they will be, of course, because we will do what it takes to get to our goals. And ultimately, that will mean that financial conditions will come along. But in the meantime, there can be back and forth, and I'm just focused on what's the right thing for us to do, and my colleagues are focused on that too.
The markets seem to think inflation is coming down credibly. Do you believe we're at the point where inflation is coming down credibly?
Listen, I welcome the progress. I think it's really good to see the progress that we're making. I think if you look at the 12-month measure, look at the 6-month measures, you see very low numbers. If you look at 12-month measures, you're still well above 2%. You're actually above 3% on core through November at PCE. That isn't to say I'm not calling into question the progress. It's great. We just need to see more. We need to see continued further progress toward getting back to 2%. That's what we need to see. So it's our job to restore price stability, and that it's one of our two jobs along with maximum employment, and they're equal. So we're very focused on doing that. As I mentioned, we're moving carefully at this point. We're pleased with the progress, but we see the need for further progress. And I think it's fair to say there is a lot of uncertainty about going forward. We've seen the economy move in surprising directions, so we're just going to need to see more further progress.
He kind of goes in that direction quite a bit, I think in general, more of a dovish position right now, which is...
in the SEP from today, growth is notably below potential in 2024. If growth were to surprise us again in the way that it has for years now by being stronger than expected next year, would it still be possible to cut rates? Or put another way, is below trend growth necessary to cut rates, or would continued progress on inflation alone be sufficient?
So we'll look at the totality of the data. Growth is one thing. So is inflation, so is labor market data. So we look at the total, as we make decisions about policy changes going forward, we're looking at all those things, and particularly about as they affect the outlook. It's ultimately all about the outlook and the balance of risks as well. So that's what we'd be looking for. If we have stronger growth, that'll be good for people. That'll be good for the labor market. It might actually mean that it takes a little longer to get inflation down to 2%. We will get it down to 2%. But if we see stronger growth, we will set policy according to what we actually see, and so that's how I would answer.
I guess the question I'm asking, if you don't mind a quick follow-up, I guess the question I'm asking is above trend growth itself a problem?
It's only a problem it's not itself a problem. It's only a problem insofar as it makes it more difficult for us to achieve our goals. And if you have growth that's robust, what that will mean is probably will keep the labor market very strong. It probably will place some upward pressure on inflation. That could mean that it takes longer to get to 2% inflation. That could mean we need to keep rates higher for longer. It could even mean ultimately that we would need to hike again. It just is. It's the way our policy works.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. How do you interpret the state of the labor market right now? And in particular, you've referred even today to evidence that it's coming into better balance. What would you need to see to conclude that it has reached that balance?
So on the better balance side, there's just a lot of things. It's you see job growth still strong, but moving back down to more sustainable levels given population growth and labor force participation. The things that are not quite, but let me go on with that list. Claims are low. If you look at surveys of businesses, they're sort of the era of this frantic labor shortage are behind us, and they're seeing a shortage of labor is being significantly alleviated. If you look at shortages of workers, whereas they thought job availability was the highest it had ever been or close to it, that's now down to more normal levels by so many measures: participation, unemployment, so many measures, the unemployment, job openings, quits, all of those things. So wages are still running a bit above what would be consistent with 2% inflation over a long period of time. They've been gradually cooling off, but if wages are running around 4%, that's still a bit above, I would say. And I guess there are just a couple of other, the unemployment rate is very, very low. And these are, but I would just say overall, the development of the labor market has been very positive. It's been a good time for workers to find jobs and get solid wage increases.
Claire?
Jones, Financial Times. I'd say the mood among economists at the moment seems to be one of cautious optimism, which is somewhat corroborated by your forecast, by this sense that we are going to have a soft landing. Yeah, when we hear from the general public, there's a lot of discord about economic conditions. What do you think explains this disconnect, and does it matter for policymakers?
It may be. A common theme is that while inflation is coming down, and that's very good news, the price level is not coming down. Prices of some goods and services are coming down, but overall, in the aggregate, the price level is not good. So people are still living with high prices, and that is something that people don't like. And what will happen with that is wages are now, real wages are now positive, so that wages are now moving up more than inflation as inflation comes down. And so that might help improve the mood of people. But we see those public opinion surveys. The thing that we can do is to do our jobs, which is to use our tools to foster price stability, which has such great benefits over such long periods of time, and which is the thing that really enables us to work for and achieve an extended period of high employment, which is so beneficial for families and companies around the country.
Victoria?
Still getting
Hi, Victoria Guido with Politico. I wanted to
definitely a
ask,
dove signal
on the flip
from Mr.
side,
Powell.
if things start to deteriorate rapidly, if we do fall into a recession, if we do start to see unemployment rise at sort of the levels of inflation that we're seeing now, how would you all think about that in terms of rate cuts? Would that be a sign that you've done your job demand-wise?
Sorry, if
the economy looks like it's starting to fall into recession, if the jobless rate starts to rise?
that's not something we're hoping to see. Obviously, we're hoping to see something very different, which is continuation of what we have seen, which is the labor market coming into better balance without a significant increase in unemployment, inflation coming down without a significant increase in unemployment, and growth moderating without a significant increase in unemployment. That's what we're trying very much to achieve, and not something we're looking to see.
But would you take that as a signal that you should cut rates?
Obviously what we'll do is we'll look at the totality of the data, as I've mentioned a couple of times, and certainly the labor data would be important in that. And if you can describe a situation like that where if there were the beginning of a recession or something like that, then yes, that would certainly weigh heavily in that decision.
Michael McKee from Bloomberg Television and Radio. Mr. Chairman, you were, by your own admission, behind the curve in starting to raise rates to fight inflation. And you said earlier, again, the full effects of our tightening cycle have not yet been felt. How will you decide when to cut rates, and how will you ensure you're not behind the curve there?
So we're aware of the risk that we would hang on too long. We know that that's a risk, and we're very focused on not making that mistake. And
All right, so that's
we
good.
do regard the two, we've come back into a better
Sees
balance
the potential
between
of a risk of holding on too
overdoing
long.
it
That's
and
going to be a
risk of
huge
underdoing it.
factor if they
Not
do
only that,
actually lower
we were
rates
able to focus
early
hard
in
on
24.
on the price stability mandate, and we're getting back to the point where, which is what you do when you're very far from one of the two mandates. You're getting now back to the point where both mandates are important, and they're more in balance too. So I think we'll be very much keeping that in mind as we make policy going forward. And the things we'll be looking at, I've already described. We're obviously looking hard at what's happening with demand, and what we see the same thing other people see, which is a strong economy, which really put up quite a performance in 2023. We see good evidence and good reason to believe that growth will come in lower next year. And you see what the forecasts are. I think the median participant wrote down 1.4% growth, but we'll have to see. It's very hard to predict. We'll also be looking to see progress on inflation and the labor market remaining strong,
S&P just
but
cracked
ideally
4,700.
without seeing the kind of large increase in unemployment that happens sometimes.
When you begin the cutting cycle, will it be essentially run the same way you do it now with raising rates, where you basically do trial and error cut and see what happens, or will you tie it to some particular measure of progress?
We haven't typically tried to articulate, with one exception, a really specific target levels, which was, some of you will remember the thresholds that we used in, I guess, 2013. The answer is these are things that we haven't really worked out yet. We're sort of just at the beginning of that discussion.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So if the Fed cuts rates, as the dot plot is showing, about 75 basis points, does that signal or that there's a belief of weakness next year in the economy?
It wouldn't, if that were, first of all, let me just say, that isn't a plan. That's just accumulating what people wrote down. So that's not something, this, but allow me to say it again. We don't debate or discuss what the right, whose SEP is right. We just say what they are and we tabulate them and publish them. So it's important for people to know that, but it wouldn't need to be a sign of, it could just be a sign that the economy is normalizing and it doesn't need the tight policy. It depends on, the economy can evolve in many different ways, right? So, but it could be more what I just described.
And you focused on core inflation. We've heard from in other meetings. How sticky is core inflation right now?
Well, that's what we're finding out, and we've seen real progress in core inflation. It has been sticky, and famously, the service sector is thought to be stickier. But we've actually seen reasonable progress in non-housing services, which was the area where you would expect to see less progress. We are seeing some progress there, though. In fact, all three of the categories of core are now contributing. Goods, housing services, non-housing services, they're all contributing at different levels, meeting by meeting, or rather report by report. So, yeah.
Okay, let's go to Katerina.
Katerina Saraiva, Bloomberg News. Thanks for taking our questions. I just wanted to ask a little bit about, we had some pretty positive data this morning and yesterday. I'm assuming those were not incorporated into the forecasts we see today. But I just wanted to ask, how that kind of adds to your thinking, on the inflation outlook.
Right. So we got CPI the morning of the first day, and we got PPI the next day, which informs the.
All right, guys. So, kind of wrapping up. He's getting ready to, exit the interview there. In a kind of a wrap up here. Obviously, a very dovish statement. I think obviously you guys have been watching the charts as we've been playing that. And if you look at what's happening right now at Bitcoin, really holding a position. I'm on the 1 hour chart right now. I'll go down here to the 15 just to show you the movement that we've seen. But this is the factor. There was two things he really got into that I think are indicative of whether or not we would see a Q1 rate cut. And that is that he didn't pull it off the table. It means that they're already discussing this. That is a good indicator. That's number one. And the other thing that he mentioned that I thought was intriguing also was the fact that he is already aware, meaning the Fed, already aware that they could hold on too long and they don't want to get caught flat-footed. So they may make an early run for a rate cut if we continue to see jobs not performing in Q1, which we'll know when we start to see the January jobs numbers and also the retail numbers coming in from the end of this month, coming in from the holiday season. That, in a way, will give us a lot more data that the Fed is always talking about. Hey, I need more data. I need more data. Well, they're going to get more data, and I think this is all leaning in. So I think, guys, we may be seeing our last little bit of a dip if we go to the, let me go to the 2-4 hour. This may have been the last little dip for Bitcoin coming into right around 40,800. So if you are looking at maybe a 46 to 48,000, which is what a lot of people are kind of leaning in on right now, sentiment still holding very strong on Bitcoin and Ethereum, and also Avalanche and Solana. Those are the 4 strongest coins right now in terms of top line sentiment on our market sentiment index. So this is going to be a very interesting next few days to see how this holds out, or if we see a market correction and a flip. Also, I think you'll start to see a lot of wrap-ups from this. We'll probably get some people on to kind of talk about this this week and go a little bit deeper on this. So in essence, very good for markets. And I don't know if you guys saw the Dixie on this. Let me kind of go back over here and just run to the Dixie real quick. Right here, this is money coming off the sidelines right there. That's money coming off the sidelines. When you have that kind of, and this is something we've talked about a while, and this is the liquidity, the amount of money that is sitting on the sidelines right now, waiting for markets to position, because remember, early moves are very critical. And this is very early in the cycle, still very early, both in the risk asset side, but even to a certain extent, some of the S&P 500 stocks that are out there, even though we did show Coinbase as well, which actually did pretty good. Actually, it was moving pretty consistent. Yeah, right here is the Coinbase chart. So that's Coinbase on the 4 hour. So this green candle right here is what it's basically coming in on at about 150. That, again, also very positive, because this simply means lots of trading action, lots of revenue for Coinbase. Likely we'll see most likely a little bit of movement on Robinhood. Yep, they're moving up right now on a green candle at almost 3%, going almost to $12. So that's another one to watch. All right, if you guys like these live streams, smash the like button. Let us know. Drop some comments down below. We do like to take questions. I think everybody was just so excited about what they had heard that, you know, a lot of depth questions, but give them to us. We love to see that. Project overviews, things like that. That's the time to really kind of dive into the live stream. If you're not part of our Diamond Circle, get in right now. It is where you're going to get additional alpha, more podcasts, more content that does not make it here on our YouTube channel. So you could be missing some big stuff over there. Don't get caught flat-footed. All you have to do is click the link down below and catch me out there on X at Paul Barron. We'll catch you next time right here on TechPath.